What is an RMD?
So an RMD is a required minimum distribution. So here we're talking about retirement plans, specifically like traditional IRAs or traditional 401ks. You have to take some money out of your retirement account once you get to a certain age. Maybe in retirement, you might be taking out a little bit of money from your retirement account, or maybe you don't need to if you have other sources of income. But eventually, once you hit age 73, and of course that's changing to age 75 for people born in 1960 or later, once you hit those ages, the government says, okay, well now you have to take at least some amount of distribution and pay tax on it. So here's something interesting that happens. So the RMD is calculated by taking the balance divided by a certain number that basically corresponds to your age. So when you start off, maybe it's about 4% of the balance, give or take. So let's say you have $1 million in your IRA, you have to take out roughly $40,000. That can put you in a higher tax bracket, so that might be something you're not expecting. But it gets worse. Each year, your RMD is going to grow for a couple of reasons. So first of all, let's say you take out 4%, but you're getting 8% maybe in stock market, let's say. At the end of the year, your portfolio, even with that distribution taken out, is more than it was at the beginning of the year. So the next year, your RMD is going to be bigger. And the other thing that happens is each year, we take that portfolio balance and divide by a smaller number. That number roughly corresponds to your life expectancy. So as you get older, the amount we divide by gets smaller and smaller. So the RMD increases every year for that reason. So we have growing portfolios dividing by a smaller number. These RMDs can really get out of hand and really put you into a much higher tax bracket than you thought. So one thing you can do to manage your RMDs is to take some distributions or Roth conversions before you hit that RMD age. So if you take some money out, that's one option, or you can just move it to a Roth account. You pay tax on it at that time, and then it can grow tax-free from then on, and that removes the need to do an RMD on that part of the money. And so when you do hit the RMD age 73 or 75, your RMDs will be a lot smaller so that you're not jumping into such a high tax bracket.